Hi, everybody. I'm Karen. Hope you're all well at home. I see some messages coming out saying people's mics are turned on or turned off, so hopefully you can hear me. So, welcome along tonight to our session on resilience and retirement. Hopefully, you're here for the same reason that I am, and that is wanting to sort of focus in retirement as we're getting closer to that stage of our life. So, for me, it's 8 years until I retire officially at the age of 65. So, hopefully, you'll be able to get some interesting information from our session this evening. So we'll make a start. So first of all, hi, I'm Karen. I'm actually wearing the same dress because I thought that way you could all recognize me. I'm a financial advisor and coach here at Enable Me. It's a job I absolutely love. And what I do is I help our clients get clarity over their situations. I help them get control of their money. It can be a difficult thing at some stage, sometimes. We give tools to help you do things better. We help you build your confidence. We hold you accountable for your goals because that's really, really important to do. And we see how we can help you save more and save faster. So, those are some of the things that we look at here at Enable Me. Tonight's session is for information only. It's not intended to be personalised advice. So, if you want some personalised advice, you need to come and have a chat to us at Enable Me. What we're going to cover tonight is things like our retirement goals and timeframes, how we craft a personalised wealth plan, optimizing your income and investments, how we decumulate. So, obviously, we've spent our lives trying to accumulate money. We're going to try to decumulate, and what are those strategies that we have in retirement? We're going to talk a little bit about estate planning options, and at the very end, there'll be a question and answer session. So, before we make a start, we're going to have a little poll and we're going to find out in our audience where are we all at the moment. So, are you already retired? Do you have 5 years until you retire? You're like me, closer to the 10-year mark, or you've got 20 years or more to go. So, if you'd like to answer that, that would be fantastic. And we'll get an idea of who's out there and what you're all interested in finding out about. Right. Okay. So we have our poll results in. So we have 34% of us have got 5 years until retirement. We've got 25% that have got 10 years to retirement. We have 14% that are already retired, and we have about 8% that have got 20 years or more to go. So good on you for those people that have got 20 years or more because you're doing the right thing. You're getting in early. For the rest of us, we need to make sure that what we're doing is right and that we are on track for where we want to be. So, right, we've done our poll questions. So, the big thing about retirement is that we all want to have a retirement that's really comfortable, the kind of life that we want to live, because, at the end of the day, we've worked hard and we get to retirement. Well, hopefully, we all get to retirement, but we need to know that we're going to be okay. And everyone's retirement's going to look different. So, we want to make sure that what we're aiming for is what we're going to end up with. There are some people that walk around that they've got no idea whatsoever what their retirement is going to look like. They just hope like mad it's going to be okay. But for the ones of us that have got a plan in place, we should know that we're tracking and we should be on the right plan and the right strategy. So, with regards to us in New Zealand, we are a little bit, she'll be right. So, our reality in New Zealand at the moment is that we have 50%, 56% of retirees have to compromise what they want to do in retirement. 41% feel that they don't have the money to do the things that they want to do. 13% of retiree households are still paying off their mortgages, and 20% are renting. It's pretty scary stuff. And there are 1 million parents that are still financially supporting their adult children. And obviously, really important to try to raise financially independent children. I know it can be hard, but sometimes we just need to say no. My daughter's 21, and I'm finally getting to the stage I can say no. So, for our future retirees, 50% of Kiwi are not prepared for their retirement. It's a really scary amount of people out there that aren't prepared. 34% could maintain their current lifestyle for 10 years plus in their retirement, so just from those retirement savings. And 70% think that they will need to work past retirement age. Now, that's okay if you want to do it, but if you physically and mentally don't want to be there, then that becomes an issue. So we do have some options to consider when we're looking at funding our retirement. One is we work longer. Now, this is a really interesting conversation. Even in my house, my husband is 2 years younger than me. He thinks that I'm going to work to 67 so we can retire together. That's not what I'm thinking of doing. But a lot of people don't end up working as long as they intend to because, as we get older, our bodies start to slow down, our minds start to slow down, and we sometimes lose our motivation, but not always. I've got friends that are in their 70s that absolutely love what they're doing and will work that little bit longer, but it should be a choice. The other option we hear a lot of is people saying they'll downsize their home. So, downsizing their home is not always what you think it's going to be because sometimes buying a smaller, more modern house is more expensive than an older home. And it can sometimes fund maybe 3 years of retirement, but not normally a lot. Another one we hear a lot of is I'm going to get an inheritance. Really lovely for the parents out there hearing that that's where their children think that they're going to retire from is from an inheritance. And that is something you can't guarantee. Like you just need to have an elderly parent end up having to go into rest home care, and that inheritance can disappear quite quickly. And you don't know that you're going to end up with what you think you're going to get. So it's not really a good strategy. Other people who are self-employed, and this is a really important one, think that they're going to sell their businesses. So self-employed people, really important that you start looking after yourself, get KiwiSaver sorted out, get your retirement sorted out, because selling a business can be a bit tricky. It may not be the right time to sell. It might be, you might not get what you want for it. You might have to work that much longer. The other option, which is kind of newish in the last probably 10 or so years, is the reverse mortgages. Can be a good option, but that's a discussion you have to have with your children about whether or not they're happy for you to do it. Not that it's any business of theirs, but maybe they can help instead. And the other option is just spend less in retirement, which is not really what you want to do. So, New Zealand super will likely not be enough unless you're mortgage free. You'll work to the age of 65, you're not helping your children, and you live a a no frills lifestyle. That's not where I want to be personally. I look at my mum and dad, they retired and they had the most, and they're still alive. They've had a fantastic retirement. They've done lots of traveling and things like that. Unfortunately, my mother-in-law was the opposite. She didn't have savings for retirement and she had a no frills lifestyle. She really didn't have a lot of extra money to do things that she wanted to do. So I think it's really important that we think ahead and think, well, what do we want our retirement to look like? What do we want to actually do? We don't want to just give up work and sit around doing nothing, right? So, what's the solution to enjoying a comfortable retirement? You do need to know how much you need to have money wise to have a fulfilling retirement, to have those choices, to be able to do the things that you want to do. So it's really important to have a wealth creation plan. So obviously we talked about being mortgage free. That's really important. But once we've got mortgage free or we're heading towards that, we need a plan that brings together lots of different types of assets, and we need to know how long we're going to hold on to them for. So there's lots of different things. Now, unfortunately, your family home is not actually an investment. It is somewhere where you live. So it isn't really what you consider an investment unless you want to sort of sell it, go live in a camper van. So we need to build financial resilience. It's really important. It's an essential part of our plans. We need to have emergency funds so that can help fill buffers. So things can happen that you don't expect. For example, I ended up having to go and have a tooth removed last week. It was $2,000. Not something that was in my plan. Luckily, I've got a buffer for it. But imagine when you're in retirement and you're on a really limited income and you've got limited resources, those little trips to the dentist and cars not working and things like that can really, really upset our plans. So it's really important we have emergency funds and buffers. And it's not just now, but it's actually all the way through our retirement. So leading up to and into retirement. So, wealth from retirement is going to create lots of opportunities to do the things that you want to do. So, everyone's retirement's going to look different. So, you might want to move somewhere completely different to where you are at the moment. You might not want to live in the big house. You might want to live in a tiny home. You might want to travel around New Zealand in a camper van, whatever it is. You might have grand ideas of living in a batch by the beach or traveling overseas. Those are things that we need to look at. A lot of people talk about wanting to retire early or as they get closer to retirement, starting to cut back their hours so they're not working, 5 days a week, 40 hours a week or more. That they might start to want to work 4 days a week. And a lot of employers these days want to keep really good employees working, so they're quite amenable to that. Also, the other thing is our health. We may need a higher level of care as we go into retirement. So that's another thing that we need to be aware of, that we might need options for that. Leaving a legacy, it's lovely to have the idea of leaving a legacy for your children, grandchildren, SPCA, or whatever it might be. But you don't want that to sort of also impinge on you having a nice life, but also is something that would be nice to be able to do, to be able to help your children, help your grandchildren. And helping your children maybe while you're still alive, it may not be after you've passed away. So that's also really important to consider. So with our wealth plans, there's a few things they need to be. They need to be flexible because things change. They need to be dynamic because we're going to be in retirement for quite some time, hopefully. We need to include built-in buffers for those rainy days, for those things that we don't always plan for, like dental work. We need to be really enhanced by our positive behaviors and our spending habits. Going from working full time, receiving that fortnightly, monthly, weekly income into your bank account is fantastic. But when you go into retirement, that stops. So, by changing some of your habits, your spending habits and behaviors leading into retirement, really helps you. So, you sort of don't go from this really nice lifestyle to jumping off a cliff type thing. So, we want to even it out. So, we want to really help you with your behaviors and your spending habits. And you need to have a really strong financial foundation. So, where do we start? So, the first thing we need to do is we need to secure your financial foundations, and I'll go through that a little bit more in detail a bit later on. We need to understand what you need. We need to determine where your money is coming from in retirement. So, it could be National Super, it could be from your KiwiSaver, you might have other investments, it could be from the sale of the business, whatever it is, but we need to understand where that is. We need to gauge how you're tracking currently. So, a lot of people, while they're working, they just spend, they enjoy their life, and they don't really think about the fact that if they put a little bit money aside, that helps retirement. But also, you need to understand what your life is actually costing you at the moment. So, how much does it cost to live your life? And then, what we need to do from there is to establish what that gap is in our savings that we're going to have to last us for the rest of our life. So, if I look at my KiwiSaver at the moment, I think, oh, that looks pretty good. That's not too bad. But when I sort of even that out and sort of divide that up by how much I earn, it's not going to last me a long time. So we have to really understand what our gap is and how we fill that. So, as a rule of thumb, we say you need roughly 25% of your lifestyle costs saved. So if you think about you turn 65 up to the age of 90, because as we get older, medical advances are better, people are living longer. So we say about 25 years of what we need in income. We really need people to be mortgage free. Even like the moment, there's been a lot in the papers about people with mortgages even struggling when they retire because of the cost of living affects everybody. When you retire, your rates don't stop, your insurance doesn't stop, they continue to go up. So, we need you to be mortgage free because then you have more control over where you live and the fact that you're not paying the bank money. Having financially independent children is really important. My daughter, as I said, is 21. Up until now, she's always rung me when she needed a little bit of money here, there, and everywhere. And being the nice mum that I am, I'll often give in and send it to her. But it's really important that you do say no because our kids have got a whole lifetime of work ahead of them and being able to make their decisions and to be able to save for their own retirement. And actually, they're going to be much better educated about retirement than probably a lot of us were as we were growing up. So it's really important that we are slightly, selfish in the fact that we look after ourselves first, or as Hannah used to say, when you're on a plane and the oxygen mask falls in front of you, you put yours on first and then you help your children. So really, really important that we do that. There's so many people out there that really want to help their kids, but by doing that, you're not really helping them. So I talked about your financial foundations. So the foundations to have really good, strong financial resilience. And I cannot do that. So don't even ask me if I could sit there and we'll lay there and do that. Can't do that. But the things I can help you with is things like money habits, making sure that you understand about being conscious with your spending, setting goals for the things that you want to do. So I've always been a little bit of a shopper. So for me, I need to have good goals that are like short, sharp, and I can achieve. As you get older, you do change your money personality. So I've gone more from being a shopper to probably more of a plodder, which kind of sits in between a saver and a vendor. So it's really important to understand your money habits and then set yourself some great goals. The cash flow management is really understanding where your money goes to. The number of people that come in to see us and they're saying, well, look, we feel like we're living, paycheck to paycheck. There's really not a lot left over. And, if we're lucky, we might be able to save $5,000 or $10,000 a year. And when we sit down and do some cash flow management with them, their surplus income could be 20 or 30,000, and they just have no idea where it's going. So looking at your cash flow management and tracking where your money goes is very important because it helps you understand where you may be frittering money that you might not realize it. Could be subscriptions, it could be all sorts of things. Debt management's another important part of getting ready for retirement. Really important not to go out and get easy, the little afterpays or the store cards and things like that. Those kind of short-term debts are not what we want. So when you're borrowing, we don't want you borrowing for your wants. You only should be borrowing for the things you absolutely need. And then as we get into retirement, we shouldn't be borrowing really at all. We should be saving and being able to have those monies available to fill in those gaps. The mortgage management's really important because as we're getting closer to retirement, we need to make sure that we have as little mortgage or no mortgage. And the sooner you can pay your mortgage off, the more capacity you've got to actually to be able to save and to grow wealth for retirement. Insurance is also really important. As we're getting closer to retirement, things can go wrong, and we need to make sure that we're protecting our greatest asset, which is our ability to earn money. If we have something that goes wrong between now and retirement, it can completely change our retirement goals, plans, and how we're going to live our life. KiwiSaver is also really important, and I did mention earlier, if you're self-employed, you do need to make sure that you're putting money into KiwiSaver. If you're working for somebody else, you must be in KiwiSaver. You're putting in at the moment, say 3%, your employer puts in 3%. It's like a bit of a 3% pay increase. So make sure you're putting in those minimum amounts so that you can get the maximum out of your KiwiSaver. And actually, just going back to KiwiSaver, when you retire, you don't have to take it all out when you turn 65. We'll talk about that later on. So success starts with adapting your money belief and habits. So a lot of people kind of think, well, I can't do this until the situation is absolutely perfect. This is happening, that's happening. When all that stops happening, I'll then get onto it. You don't need to do that. You just need to start now. Some people will say, well, look, it's too late. It's too close to retirement. I'm just going to give up. You can't do that. Today is the day you start to do something. Now, I've got 8 years to go. I'm making sure that every cent I have is, working towards my retirement. And some people feel that they need to have a lot of money to start to build that nest egg. They don't. You need to start to save and save. Even this little bit, it just builds up and builds up. So when to start? So our preference is you start as soon as possible. Lyndon Johnson said yesterday is not ours to recover, but tomorrow is ours to win or lose. And really, today is the day that we can start to make some really positive changes. They don't have to be massive changes, but a little bit, 1% on top of 1% every day starts to really build up. So KiwiSaver really does help. So when you see the three little piggies on the bottom, the big round circle above that is the average KiwiSaver balance for 56 to 60-year-olds at the moment is $65,000. That is not a lot of money. For most people, that might last a year. So if your lifestyle costs you about $80,000 and you've got 25 years worth of $80,000 that you're going to need about $2 million. So if you have some pension KiwiSaver contribution, sorry, the pension contribution is about 700,000, that's National Super, and then your KiwiSaver. So you're going to have a gap in the situation of about $934,000. That's a lot, but that's not something that can't be fixed. So sometimes when we look at those numbers, we just think that's too big, we can't do anything about it, but we can. So what's really important is we start to look at our time frames. So this graph here shows you that if you are the average New Zealander, so the average New Zealander buys their first home at the moment at the age of 56, the banks go out and say, right, you can have a 30-year mortgage. That's fantastic. You tootle on making your payments over the next 30 years. Next thing, you're 66 and you're heading towards retirement. There's no time to really save. So this actually shows you the fact that at 65, you've got your KiwiSaver. Next thing, 69, you've run out of money. So what we need to do is get you mortgage free really quickly. So at Enable Me, it's one of the things we're absolutely fantastic at helping our clients do is to get mortgage free quickly. So if you can get mortgage free earlier, so there's a lot of people here that had 10 years or more before retirement. So if you can get mortgage free at the age of 65, then obviously that gives you 10 years to do some wealth creation. So creating wealth for those 10 years means that the wealth that you've grown will last you until you're about 80, which is not too bad. We want to get to 90 because we still want to have a nice retirement later in life. So the big difference comes when we get mortgage free and we get a proper wealth plan in place because that wealth plan enables you to grow your wealth, grow your assets, grow your money, and it should then last you until you're about 90. Now, obviously, our lifestyles change as we're getting older, but those are the things we need to think about. So there's lots of different ways that we can grow our wealth, and there's things like cash, which is not so good, term investments in bonds, there's managed funds, there's different types of EFTs, there's properties, there's shares, there's businesses. There's a range of different types of investment growth potential, and they all have different risk returns. If your retirement gap is more than $300,000, now we can help you work that out, then you're more than likely going to have to use leverage to actually help get that amount of money growing for you. So this is a really important graph that talks about leverage. So the orange side here talks about the fact that you've got $160,000. You put it into some managed funds and you get a return of 6%, which equates to $9,600 a year. If you could use your property and $160,000, you then have an asset that's actually worth around about $800,000. So your 6% return on that $800,000 is actually closer to $48,000. And that's the power of leveraging. You're actually using the bank's money to grow your money. So leveraging is really important. It's a very important tool for us. So when we're talking about investment properties, not every house makes a good investment. So when we talk to our clients about their investment properties, or if they're going to buy one, we want to make sure that they fit a set criteria that's going to give them the growth they need. And you need to know things about if it's right to hold it. And sometimes you have to cut the cord and say, well, that wasn't the right one. Let's go and get a better one. So you need to know if you should buy and sell a new property, whether you should sell and invest elsewhere, whether you keep it and you use the equity to buy another property. We have clients, I had a client last week, they had a property that they have as an investment. It's in Auckland, it's worth about $700,000. They're receiving $475 a week in rent. And then they have their rates and insurances, property manager fees, etc., coming out of that. That isn't the right property to hold on to. We really need to get them to find a better property. It might be another property or might be investing elsewhere. So if you have investments already in an investment portfolio, it's really important that you review those, on a regular basis. We need to look and see what the market's doing. One thing I would always say is when our Kiwi savers or investment portfolios dip, and they've done it several times, for example, after the GFC, after COVID, after Donald Trump talks about tariffs, they often drop. And so when that happens, it's really important that you don't get cold feet and draw your money out or change your strategy. It's really important you give them time to rebound. So your time frame is really, really important. But you should be looking at how much needs to go into what different types of time frames and the right funds that suit it. So we look at the growth compared to other investments. We look at how long we need to hold it and how long that's what it's going to cost. And when we need to liquidate it, what do we need to put it into? And if you're not sure, get some financial advice. Again, as I said, when you turn 65, we've seen this a lot. People just take all their money out of KiwiSaver and they put it into a term investment. It's not the right thing to do. Your KiwiSaver can provide an income for you during retirement. You don't have to take it all out in one lump sum. If you've got money in the bank at the moment, you'll be seeing that the OCR cuts means that the interest rates are actually dropping on term investments as well. You also lose value due to inflation. So that's our cost of living crisis we're in at the moment. Our money sitting in the bank actually earns or is worth less. So you need to look at ways of making it work harder for you. So whether or not you can pay off a mortgage or investing in a different way, but you still need to have some money available to you in case of an emergency. So you don't tie everything up. You have money available for you to cover that shortfall in your retirement for that year. So accumulation to decumulation can be quite hard for people to do. So accumulate takes a long time. We spend our working lives accumulating money, and then when we go to decumulate, it can be really hard for people to actually start spending the money because they have that concern and that fear that their money is not going to last as long as they are going to. So you need a really good strategy that you understand what your cash flow needs actually are. If you've got kids, what do they need? You need to look at your risk versus your returns and make sure that you're really comfortable with that and that you can absorb those volatile moments. At the moment, Donald Trump is the big volatility out there in the marketplace. I think we've all seen our Kiwi savers go up and down, but you need to be able to be confident that your strategy is right. And the time frame and the money and the way it's invested is sitting in the right places for you. So when we're accumulating our wealth, we need to look at, can we live off of our investment returns? So that can be quite hard to do. It's not always easy. Um, We can set a certain amount that can be withdrawn from your investment every year, or it can be done monthly or fortnightly. That might eat into some of your capital, it might not. It just depends on how it's invested. Or otherwise, we take out a percentage each year and try to keep our capital there so we've got it for those other things we want to do in life. And then we've got the phased approach, which is where you get a lump sum paid out every year in different amounts. So when you're looking at your retirement, and I always think about my mum and dad, when they first retired, we hardly saw them. The first 10 years, they were off overseas all the time. So when you first retire at the age of 65, or 67, you tend to do a lot more because you've suddenly got that freedom that you don't have to worry about taking time off work. You can go away whenever you want to go. You don't have to sort of wait until it's a time that's convenient for your employer. So you start to do all those things that are on your bucket list. And those things tend to be a bit more expensive. So I've got clients that are buying camper vans and traveling around New Zealand. I've got other clients that are off over to Europe to do the big OE that they couldn't do when they were younger. So those first 5 to 10 years, we do spend a lot more money. So that's where we're sort of really enjoying our retirement, and we're living the great life we wanted to live. After that, we get on to our next 10 years and people become less active. They start to have health issues, and I'm seeing this with my mum and dad at the moment. When they were off traveling all the time, now they're sort of slowing down and they just enjoy sort of doing things around home. They're not off traveling all the time. So it's really important for them just to continue to invest their money and to grow it. So that they can make sure that they have that nice lifestyle that they want, and preparing for the fact that potentially they may need more money to be spent on health, and care in the final years. And so those final years are probably the times when we spend more money on our health, but we do less in other ways. I mean, some people are quite sprightly and will carry on doing what they've always done, but generally, those final years, we don't have to spend quite so much money, and we start to think about things like leaving legacies and money for our children. Protecting your assets is really important, and I've put in here about insurance policies and blended families at the top too there. And the reason why I bring that up, because a lot of people like myself have had previous relationships and have children from other relationships and are then remarried, and there's blended families. So as we're starting to think about protecting our children, and we don't want to disinherit them because that can happen quite easily if you leave everything to your partner and your partner's got children, you've got to trust that they're going to then leave your children an equal share of everything. So you can actually take out insurance policies for your children so that if you died, they get that, and then your husband or wife can continue living where they're living and not having to worry about selling the house. So there is a place for some insurance policies, but not just to leave them something. But if you want to make sure your families are cared for and you've got a blended family situation, that's a really important thing to look at. Trusts are important. Some of them are still valid to have. They do protect beneficiaries, but you've got to have them for the right reason. Ownership structures of your property is also really important, just the way that you've worked out whether or not your tenants in common or whether or not you just share 50-50. That's also an important thing. Sometimes people get left a lifetime interest in a property. That may mean that your children actually don't see much of their inheritance. So it's really important to look at those relationship property agreements. My husband and I, once we'd been together for a year or so, we entered into a property sharing agreement. We've never had to worry about it again since, but it just means that if anything was to happen, it's all very clear. We know exactly what's going to happen with our money. So with regards to leaving a legacy, because there's a lot of kids out there that think that their parents are going to leave them money and they don't have to worry about saving for themselves. They can go and have a great life and not worry about it. So it's really important that you set your expectations with your children about what they're actually going to get, or maybe what they're not going to get. Trust, as I say, do protect beneficiaries. So that way your trust and your wills mean that the people that you want to receive something from you when you pass away do get it. So it's the right people getting those monies. So we want to make sure that we're building into our wealth plan. You also need to see if you need to have any others help you, if you've got to cover your own costs in retirement. So moving into retirement homes, things like that, if we get ill when we don't expect it. So some of the really essential things that we need to look at is our estate planning. So you must have an up-to-date will. Especially if you've gone into a new relationship, make sure your will is up to date, that you're leaving it to the people that you want to receive the money. Power of attorney is really important as we get older. My father-in-law recently had to go into a retirement home. Trying to get a power of attorney sorted out was a nightmare. If you leave it too long, you have to go to the court to do so. While you're young and you're able and you know what you want, get your wills and your power of attorney sorted out. Trust still have their place. They still do. Making sure that again, while you're, with it, you know what you want to have happen. Make sure you've got some medical directives out there and a living will, so that the people that have to make the decisions about you know what you actually want. The rest home subsidies is a really interesting one. There's a booklet that they put out. I've got it sitting here by my desk. Residential care subsidy and residential care put out by the working income tells you exactly what amount of money you're allowed to hold on to um, before you actually then have to sort of pay for your own rest home cost. If you don't have assets going into retirement, there are subsidies available. If you've got money available, rest homes can be quite expensive. I've heard of people paying $6,000 to $9,000 a week in certain types of care. So, just for those people that are thinking they're going to get an inheritance, those rest home subsidies or lack of them can actually really eat into that amount that you're wanting to leave somebody. So, with our takeaways, we really need to understand where you need to get to and what your time frame is. So, for me, is 8 years. I know what my retirement gap is, so I'm working really hard at the moment to do everything I can to be really conscious of where I spend money. I'm still living a good life. I'm off to Bali on Friday, so still living a good life. We don't want to have a little life, we want a big life, but we want to have a big life when we go to retire as well. So it's really important to understand what your gap is and work on strategies to actually plug that gap to actually fill your wealth that you need. If you have investments, you need to make sure that they're working really hard for you. If you've got money just sitting in bank accounts, they are not, your money's not in the right place. It will be going backwards at the moment. You need to determine how you're going to manage your finances once you retire. It's really important to understand how much you need each year and how are you going to get that money to last for that period of time. So managed funds are great. You need to sit down with a financial advisor to work out that amount of money, will it last you? And if you want some of that left behind, we can give you some good projections to tell you how much you could have left at the age of 90. You need that protection plan in place because if anything does happen, it will interrupt your chances of having a great retirement. So it's really important that the right insurances are there. They do get expenses as you get older. I love the way that I get a letter once a year on my birthday from my insurance company. I always think it might be a little thank you very much, Karen, for having your insurances with us, but it's normally your insurance premiums are going to go up. So it's awesome. You love it, right? As you get older and you need it more, it becomes more expensive. So, how can Enable Me help? So, at Enable Me, we are financial coaches and we partner with you to help you create a plan that's going to fulfill your retirement dreams. We do that by working out what your starting point is. So, we do a lot of work diagnosing where you are today and where you need to be. We look at that landing point. So we say, well, here you are. This is where you need to be. How do we get you to get there? We look at your capacity or capability to actually grow your wealth. And this is where I say a lot of our clients come along and they go, but we're living paycheck to paycheck. We just don't feel like we're getting anywhere. And often what it is that money is being frittered away in areas that when you look back, you think, actually, that was a friggin' waste of money and I wish I hadn't spent it on that. And that can be as the simple things as having subscriptions to streaming platforms that you never use. I had one the other day. $176 for Acorn TV. Last year, I must have been bored. I signed up for Acorn TV. I've never watched it, and then it came out of my credit card. I was like, what the hell is that? No idea. Now I'm trying to work out how to cancel it. But sometimes it's just the tracking of those expenses, and you think, well, actually, I don't need it. Let's get rid of it. But we want joy in life, so we still want to have a nice life, but we just want to make sure um, that we know where our money's going. So we need to design a strategy to grow wealth. And sometimes that's through an investment property, sometimes it's managed funds, but it could be a mixture of all of those things. But the only way you're going to find out is actually to get some financial advice and help you get ahead. So we need to really have somebody there to help you make those decisions. So a lot of people come to us and they just need a sounding board. They just want someone to talk to about, am I on the right track? Am I doing the right things? And sometimes they're not, sometimes they are, and sometimes there just needs to be a few tweaks. But it's really important that you get the right advice. It would be like just listening to Dr. Google every time you had a symptom of something not being right. Dr. Google's not going to give you the right advice, whereas going to your doctor will. Same with solicitors. Anyone that is, qualified to give advice about something, they're the ones you want to see, not your next door neighbour, not your mum and dad. They're not always the right people to get the right advice from. These are the people to get the right advice from. We've got an amazing team of experts at Enable Me. We're all here to help you get ahead. What I absolutely love about Enable Me is that we are all salaried employees. We do not get commissions. We don't get bonuses and things like that. We're just here to really help you get ahead. So, we're going to do some question and answers in a second, but we do have a special offer tonight. So our producer is going to do a draw, and somebody who's attending tonight's event will receive a free financial consultation with one of our financial advisors. So our producer will be getting that information and will tell us who that is. If you would like to have a consultation, take a copy of the QR code here. If you do book tonight, the consultation will cost $149. If you book in after tonight, the consultation will be $249 if you've attended the session. Normally the cost is $400. So we're going to go to Q&A now. So I know we've got lots of questions. I don't know whether or not I'm going to be able to answer all of them, but I will try my absolute best. So Jess, do we have some questions there?
Yes, thank you so much, Karen, for such an incredible webinar, first of all, I'll just call out the winner of the free FC. I did a draw behind the scenes. Congratulations, Kath Short. Well done. So give us an email and we will connect you with a coach. But yeah, so let's get into the questions.
Well done, Kath.
Yeah, congrats. So first question, Karen, is there anything I need to consider for calculating how much I need for retirement as a single person?
Yeah, that's really, really important because we talk about the single person's tax, and obviously that is that you pay the same as a couple for a lot of different expenses in life, your rates, your insurances, you pay the same amount. So the really important thing is to understand what your life is costing you. And from there, we need to make sure that we understand what is available to help you as you're going into retirement. So there's things like the rates rebates, there's the winter power amount that you get. They all sort of help you, but really you've got to understand how much life costs you and what your shortfall is going to be. You could look at other options of maybe, getting a flatmate in or somebody else that's in a similar situation. But if you like living by yourself and you don't want to do that, you need to really understand what you need to actually live that great life that you want to.
Thanks, Karen. Next question is any tips for conversations around retirement with partners? And there's some context to this one. I've seen many situations where long-term partnerships have ended later in life and women have been shortchanged due to having less money in KiwiSaver from the gender gap. So any advice for this?
Yeah, look, the KiwiSaver thing is really important. I see a lot, particularly women, and this is not being sexist, but this is what it is. A lot of women don't put as much money into KiwiSaver, and that might be because they've taken time off to look after families, or for some particular reason they just don't earn as much, or they just don't feel it's as important. But it's really important to join KiwiSaver to make the most of it while you're working. If you've got a mortgage, just try to do the minimum in KiwiSaver. But it is difficult if you have a relationship that breaks down. If you've got a property sharing agreement, that's a really important piece of work. If you don't, everything's 50-50. But it's really, really important that you look after yourself and you make sure that you've got your KiwiSaver working as hard as you can for you. Um, the other thing is age difference as well in relationships. So, yes, if you do break up as you're older in life, it is hard because you've got to rebuild, but it's hard whenever you break up. I broke up with my ex-husband probably about 18 years ago, and have to start to rebuild. It is really difficult. It's half of everything you had. But also the difference in retirement ages is something that you really need to have a good conversation with your partner about. My partner's he's only less than 2 years younger than me. He thinks he's a toy boy. He's not. But I do see people that can have an age difference of 5 to 10 years. And you have to start having those discussions about, well, how do we retire? Do we do it together? Or do we sort of kind of meet in the middle somewhere? So it's really about having good open communication with your partner about all of these things. You just don't leave it to the last minute.
Thanks so much for that, Karen. Just a couple that's come through live. One of them is in sh- she's saying, I'm in Christchurch, so do you have an office here?
I'm
And
in
in order
Christchurch
to,
too.
I knew you would love that question.
Yes, we have an office in St. Asaph Street, in Christchurch. So yes, but I am available on video phone as well if you can't make it in, or if you're anywhere else around New Zealand.
Nice. And then another one, I just wondered if you could give a little bit more detail about the consult. So the question was, how long is the consultation for 149?
Okay, so the consultation normally lasts 90 minutes. It's 19 minutes of just talking about you and your financial situation. So we use that to uncover where you are today and where you want to be. So there's quite a lot of talk about, what your assets are, what your debts are, what your KiwiSaver is, how you're saving for KiwiSaver. We talk a lot about what you want to achieve in life because everyone's retirement does look different. So we talk a lot about that. We talk about your money habits. We talk about the psychology about why you do what you do with money. And then we go through and see what your capacity is to actually save more. Not in the way that we're going to say you have this restrictive, tiny life. We want you still to have a good life. But the 90 minutes is all about trying to understand where you are today and where you want to be, and whether there is an opportunity or a chance that we can actually help you. Get ahead to where you want to be. So it's 90 minutes. Although if you do come and see me in Christchurch, I do talk a bit. So sometimes that can be a little bit longer. So if you're a bit of a chatterbox like me, then maybe allow maybe closer to 2 hours, but 90 minutes officially.
Thanks so much for that. Probably time to answer a couple more questions.
Mhm.
Um, so how do I factor in inflation to work out the projected income needed to have a pleasant retirement?
Inflation is one of those really funny things at the moment because, the cost of living crisis is obviously a worldwide thing. It's not just in New Zealand. So we have to be really mindful of the fact that things get expensive all the time. On the radio the other day, they were talking about the fact that insurances for house and contents insurance have gone up 900% since 2000. That's huge. Rates are going up. So what you need to think of is something costs $100 today. In 10 years' time, it's going to probably be 130. So we have to factor in that everything is going to cost more. Hopefully, KiwiSaver continues to grow. Hopefully, superannuation is sort of continues to increase at the rate of the sort of cost of living. Um, it is a difficult one when inflation jumps so quickly, and that's why the government at the moment is obviously so mindful of trying to reduce spending to try to get those inflation rates down. bringing interest rates down is great for people with mortgages, not always so good with people with investments, but it's obviously trying to stimulate the economy so that we actually, try to balance inflation and, spending and getting the economy working. But I think at the end of the day, everything will always cost more than it did 10 years ago. It's just a fact of life. So yeah, we factor it in, and it's just something that we have to understand is going to cost more in 10 years.
Thanks so much, Karen. Probably time for just two more questions. Sorry, there's so many good questions coming through, but we just are running out of time to answer them all. So just quick fire. So one from Liz. What happens after the 90-minute financial consultation? Do we have another session after that? Maybe it might be a good chance to talk through the programs and things like that.
Yeah, so look, at the end of the 90 minutes, if the strategic coach that you see thinks there is a way that we can help you, we run programs at Enable Me. Our programs are designed to help you achieve lots of different things. So for a lot of our clients, it is about trying to get mortgage free, and to do it faster than what your bank would predict that you do. We have our Master the Mortgage programs, then we've got our Future Ready programs, which is probably the two programs that people here tonight will be interested in. Future Ready is all about looking at what you have now, what you need for retirement, how much is your money going to last you? Because one thing my mum and dad said to me when they retired, I said to them, "What's your greatest worry?" And they said, "We don't know if our money is going to last as long as we do." So as in, will they die with no money? Will they have no money before they die? So what we can do is work out what your cost of your life costs. So how much do you need every year? How much have you got? And we can see how long that should last. And that's with also bringing in things like replacing cars, going on holidays, giving gifts to your children and grandchildren, sort of building everything in. It's easy to say, well, just get your income and, multiply it by 25. Well, that's not quite how it works. So we get quite in depth. We do quite a lot of tracking with our clients. So tracking your money helps you have really good visibility and understanding of where you're actually spending your money. And it really makes you conscious of when you pick something up to buy, do I really want this? And often you just change your mind when you actually start to have a spending plan to work towards. So after the consultation, the strategic coach will make a recommendation to what we think we can do. And if there is a program that's suitable, we will make that recommendation. There's obviously no obligation, but for most people, you can listen to all the webinars under the sun, you can read all the books under the sun, but you need someone that can help you put a plan together and help you be accountable for what you're doing. And if you're husband and wife or you've got a partner, you might have an enabler. My husband's an enabler. Like I'm a bit of a, I think I said earlier, I'm a bit of a spender. And if I see something, my husband will go, yeah, go ahead and buy it. You deserve it. And I actually have to stop myself and go, actually, no, I don't need it. But look, money personalities really come into play when you're looking at your money and understanding how you spend. So our coaches actually help you. So most of our programs are 12 months, some are 6. But what we do is we have quarterly meetings and we actually help you understand where your money's going. We set goals, we keep you accountable, we help you track, we help you invest, we help you pay off your mortgage to help you get to those goals that you need to get to.
Thank you so much, Karen. Just one more question and then we can wrap
Sure.
things up.
Mhm.
Um, so this one is, does the initial consultation include both partners' income or do we need to have separate consultation?
Well, look, we do prefer if you've got joint outgoings that we do a joint program for you. So ideally, it's both people's incomes and outgoings. With the tracking, it makes it so much easier. If your partner's on board, you will achieve more. If you come along by yourself, you might, we would call have a hostage being dragged along. We don't want any hostages. We want you guys to do this together because if you both work towards the same plan, the power of two people being focused and being very direct about what they're wanting to do, you will achieve a lot more. So ideally, we would prefer to have both people in a relationship together at the consultation. And yes, we would look at both incomes and outcomes. Some people do not share bank accounts and they keep things separate, and that's fine. It may not be as easy, but look, we'll work with you to achieve what we can.
Thank you so much, Karen. And I thought just one last question that
Sure.
someone wants to book in Christchurch. So when do you get back from Bali, Karen?
I get back from Bali on Monday, I think it's the 8th of September. I know my calendar is already looking a bit booked up, but my calendar's available online to book in. We've got an amazing onboarding team that will help you. But yeah, I'd love to see you. I think we've got, I love people in Christchurch, but I love people from everywhere, but that's okay. But no, I'd love to see you. But also, if you're on video anywhere around New Zealand, myself or any of our strategic coaches are really happy to help. So, yeah.
Oh, thank you so much, Karen. I'll leave it to you to wrap things up.
Yeah, well, look, guys, I'm so glad you all came along tonight because, at the end of the day, we all want to get to retirement. We want to have a great life. At Enable Me, we want to be able to help you get there. As I say, you need to talk to someone that is an expert. We're not experts at everything. I can't fix a car, but I can help fix your financial situation. So please come along and have a chat to us. We're genuinely wanting to help you out. So I'd love to see you. So please book in, take advantage of the $149 tonight. And yeah, hopefully we'll see you soon. Have a good evening, and I'm going to go and pack my bag for Bali.